My name's Amanda Lake, and I'm a marketing specialist at Genscape. Thank you for joining our webinar today, Latest Global Oil Market Trends and Expectations, Increasing Crude Inventory Pressures with Little Slowdown in Global Production. Just a few housekeeping items. Please submit your questions in the box under your screen. We will answer them at the end of the presentation, and also remember to take the survey that's on the left-hand side of your screen at the end. Today's speakers are Brian Bush, Director of Oil Markets at Genscape, and Alex Pierce, Oil Research and Forecasts with Thomson Reuters. I'll hand it over to Alex.
Thank you, Amanda. So I'd like to start with discussing our approach on looking at vessel flows. So all the data I'm going to present to you today is built using our bottom-up analysis of vessel-based movements. So at Reuters, we've developed a powerful tool to allow users of our Icon software to track commodity flows in real time, both on a global map and also on an aggregated basis through modules. So this allows filtering by country, grade, and vessels. So here, for example, I'm showing you a map which indicates dirty laden VLCC carriers. Each one of these points on the map can be analyzed in more detail, and you can look at the track of the vessel as it moves around, its size, its status, intended destination. So this tool is very important for us and uses this kind of bottom-up approach for vessel analysis. So the first thing I suppose is of interest is, why track vessel flows? For us, the benefits are quite obvious. You can know the imports and exports in real time. Most common sources in this kind of information, such as OPEC, the Joint Oil Database Initiative, EIA, have data lags. Our data is independently sourced and checked by a team of analysts. Data can also be segmented by things like destination, vessel type, the grade, and this can gain some insight into things like the supply trends and buying patterns of certain customers. And we think this establishes a better view of the competition and the marketplace itself. But obviously, this kind of analysis has its own challenges when we look at kind of vessel movements and flows. Accurate fixture information is quite difficult to come by. Multiple grades can load from the same ports, causing some difficulty when undertaking this kind of analysis. Determining the port and berth loading profiles. By this I mean what kind of ports load what kind of products and what kind of berths also load and discharge types of products. This information, again, is quite difficult to ascertain and takes a lot of research and analysis. Tracking the type of cargo, so whether the vessel is carrying a clean product or a dirty product, such as crude or fuel oil, or clean in the sense of things like distillates or other kind of clean products like gasoline, can be quite tricky. Also handling things like a multi-port load and discharge, so where a vessel may load at more than one location or conversely discharge at more than one location, can be quite difficult to track. And then there's also things like STS transfers, so ship-to-ship based transfers. And lastly, because the model uses AIS coverage, which basically determines where the vessel is in the world, this can sometimes itself throw up some problems for us in terms of whether the vessel is, where it's going to. So these are a number of challenges that we have. In terms of trying to overcome those issues, we have a tracking methodology which looks at vessels moving on a berth level. So our approach uses a monitoring of these calls by vessels at these berths, and it's supplemented by things like fixtures and a review by our analyst teams to make estimates on not only the start and end point of the vessel movements, but also things like the quantity loaded and the estimation of what grades of crude have loaded. And we also have some algorithms as well which estimate the intended destinations where AIS tracking fails to join the missing parts of the journey. So we also look at multi-loads and discharges as well. So again, I've got a few examples on the above the text there, which is from our map itself. And our flows are able to handle this sort of multi-port loads and discharges by monitoring the stopping points that are not for bunkering, and also monitoring changes to the draft from the AIS of the vessels. We also have spent a lot of time trying to improve the handling of STS transfers by tracking which crude grades have loaded from hubs like Fujairah, and allowing us to track the flow from a load point to transfer an eventual discharge point. So it gives us quite a good overview of how these vessels kind of move using our kind of interactive map and our kind of analyst coverage and analysis of these kinds of flows. So with this kind of tool built, we thought, what would be the best thing to perhaps start looking at using this kind of bottom-up approach? We felt that, OPEC being such a sort of prevalent driver of price at the moment is something which is very worth tracking. So we've begun tracking kind of OPEC exports independently now for sort of several months. And our outputs are kind of as follows. So this here is our independent view of OPEC exports. Considering the importance since their decision in maintaining their production, despite the lower prices, we felt it was really important to have this kind of independent view of exports and also provide this information in a kind of more timely way, which isn't really available in the market. So the information also allows us to kind of segment based on things like weekly loadings, and we can also look at buying patterns in terms of who's actually buying the crude and how much. So, our analysis highlights that there's been a push by Saudi Arabia as it exported an increasing amount of production during April and June in particular, with the country pushing more production towards Asia, as well as in support of strong margins led by the gasoline demand. A buying spree of grades that made up the Dubai benchmark from Chinese companies during August caused the Middle East benchmark to soar, placing exporters such as Saudi Arabia in a difficult position. So we saw September exports fall as a result of seasonal maintenance. But as well as this, it was price disadvantages relative to other Brent index grades. So with an easing of the Dubai futures and sort of more competitive pricing for Asian buyers from the OSPs, we saw increased demand from OPEC Gulf crudes during October and November. So you can kind of see in our chart above, which is the most recent view, particularly in October, which is the bottom segment, you see that Saudi Arabia exported somewhere around 7.34 million barrels per day. So they really have kind of made a little bit of a push, and we think that's really down to this kind of cut for the OSP buying. And also this is to displace some of the grades that Asia typically buys using benchmarks from other regions. So, as I mentioned before, if we look at the kind of buying patterns, which is something which our data allows us to do, we can kind of look at some of the bigger buyers, such as China and India. So, with increasing focus on the availability and validity of Chinese data for commodity consumption, it's become increasingly important to undertake an independent analysis of crude imports into the country. And it also provides some interesting insights into how sellers of crude have battled to keep their market share. So Chinese buying of OPEC crude remains fairly stable at the start of the year, but as we move into Q3, we notice Iraq and Angola start to make gains over Saudi Arabia as China begins to diversify its crude buying, so it's looking for more value, particularly for its SPR buying sprees. With the easing of the Dubai-related benchmark relative to Brent and declining demand for spot cargoes during the autumn maintenance, China appears to have reduced its buying of Angolan cargoes in September, having bought a higher volume during August. Saudi Arabia decided to cut its November OSP to reflect a weaker Dubai market and to boost demand for crude at a time when seasonal demand in Asia and the US typically reduces the demand appetite. So what's also interesting, we saw Dubai and Murban crudes increase significantly in October, which is highlighted on the other category under October on the left-hand side. You'll see it's 28%. This was really down to a buying spree by Chinese companies during August, which resulted in an increase of physical deliveries from the United Arab Emirates. So with lower OSPs from Saudi Arabia for November, it appears that the country has really kind of clung on to its market share. Here we can see it's about 29% as a representation of other OPEC countries. So it really seems like their strategy of cutting the prices and trying to attract Chinese interest has really kind of kept onto their market share at around about 30% mark. India is quite an interesting example because they're perhaps one of the main beneficiaries of a heated market share battle, typically kind of taking advantage of falls in spot cargo pricing due to their ability to adapt their crude slates to accommodate different grades. So Saudi Arabia is still the largest provider to the country, although in June we saw Iraq make a big push for market share as exports ramped up, which seemed to have knocked Saudi Arabia off the top spot. Shares of Nigerian grades to India also fluctuated as the spot market could be volatile, which can push more barrels towards Europe if buying interest in Asia results in an overhang of cargoes. So India is also a major buyer of Iranian crude, and it's likely to be a major target for the country alongside China once exports resume. So this really poses a competitive challenge for countries like Saudi Arabia and Iraq, which offer similar specification crude grades. So if we look at kind of how the Brent Dubai prices, which I mentioned before, influence Chinese buying, here our tracking shows that the changing proportions of Saudi exports to China, which are priced on the Dubai benchmark, relative to those from places like Russia and Angola, which are priced off of Brent. So the Brent Dubai FS, which is shown as the yellow line here, shows the spread between the two pricing mechanisms. And it indicated in May that the average Dubai value was lower than that of Brent, and it appears to have had a positive impact on Saudi's market share, which you can see sort of rises to 52% between the three countries. It seems that Saudi Arabia struggled to balance the impact of higher Dubai prices with its pricing formula during August and September, which resulted in Brent price grades such as Russian ESPO and those from Angola being increasingly favoured by China as it looked for opportunities to fill its SPR and also open up crude buying interest to independent refineries, which seemed to have had a real kind of impact on Saudi's share. So it seems the reaction of Saudi Arabia was to lower its OSP prices to Asia for October and November in order to try to counter the shifts in pricing and retain its market share. So while China aims to not exceed any one source above 20% of total imports, Saudi imports were overtaken by Russia in September, according to official customs data, with the country importing somewhere around 983,000 barrels per day compared to Saudi's 961,000 barrels per day. It's about 42% higher year on year, basically, in comparison. So Russia really has kind of made some inroads there, and I think this is going to be something which is worth watching in the future. So if we kind of look more in depth at kind of the comparison between Russian ESPO versus Saudi grades to China, we can see this kind of interesting dynamic in the market battle share. Spot prices of Arab Light relative to ESPO narrowed considerably in September, and we saw the gap in seaborne flows of the grades also come much closer together. So once we take into account pipeline flows, which aren't shown here, Saudi Arabia's dominance in China has been frequently challenged by Russia. So we're therefore likely to see these kind of producers tussle over the next year as Chinese SPR buying grows. We estimate somewhere around 60 to 90 million barrels of buying is going to happen next year to China. So between these two countries, there's likely to be a lot of competition to kind of solicit their interest. I mean, one reaction of Saudi Arabia to this threat has been looked to the European market for its crude to effectively challenge the dominance of Russian Urals in Europe. This is something which I'll talk on a little bit more in detail later as we look at European flows, but I think it's certainly something which is worth keeping an eye on. So something else which our data allows us to do is look at weekly loadings as well as we kind of move through the different weeks and loadings. So, I mean, typically Saudi loads around 7 to 8 million barrels per day per week. So we saw in September this number fall as low as 6 million barrels per day as Asian interest fell and pressure to compete for buying interest seems to have taken its effect on outputs. So the OSPs, which are shown on the left-hand side, we can see how Saudi Arabia was forced to lower its OSP in order to try and compensate from the competitive pressures it was receiving from its Dubai pricing formula. So they cut the Arab Light by about 30 cents, medium by 50, and heavy by 80 for October deliveries. So that seems to have had a positive effect on the exports, although demand was likely to increase as seasonal refinery maintenance was completed in Asia. We kind of turn our attention to Iraq now. Iraq has mounted an increasing amount of pressure on its other OPEC partners, such as Saudi Arabia and Iran, as they sort of share many of the same customers. And since the split of the Basra blend into light and heavy streams in June, the quality and quantity of the light grade has become more desirable for refiners in Europe and Asia. So while Iraq has had some teething problems in maintaining its exports above the 3 million barrels per day mark due to the sort of technical issues we've seen, port congestion, they appear to improve the loadings at the southern terminal in Basra, and we're seeing weekly loadings frequently reach above 3 million barrels per day. Kirkuk is something which we also track, and which is exported from the Turkish port of Ceyhan. And this has also seen a significant disruption in recent months as attacks on pipelines and an ongoing budget payment dispute between Iraqi SOMA and Kurdish KRG means autonomous sales have increased. Although technical issues have prevented sales from reaching sort of previously monthly levels of around 500,000 barrels per day. Desirability of Basra can also be impacted by the fact that cargoes are frequently traded on the spot market. So unlike the Saudi cargoes or Iranian cargoes, opportunistic buying can kind of swing barrel purchases if prices become more attractive. And this can obviously displace additional purchases from Saudi Arabia. So this is something which we've seen quite a lot within sort of Asian customers in particular. The country has frequently overtaken Saudi Arabia as the largest monthly crude supplier to India, with September imports of Iraqi crude overtaking Saudi Arabia for the third time this year. And it's obviously frequently challenged Saudi Arabia as the largest provider to China. Noteworthy is also the sharp decline in exports to the US, which you can see on the bottom here for November, as Latin crudes such as Colombia's Castilla and Mexico's Maya offered better value to US refiners. Something which we've also been tracking quite actively as we look at kind of vessels is the effects of Iranian floating storage. So Iran's particular interest in the market as speculation increased on the volumes of crude stored ready into market. So obviously what we understand is for the most part this kind of storage is mostly condensates, but we have seen kind of overall levels falling steady since their June peak, below the 6 million barrel draft mark to just under 27 million barrels. Based on the draft, or about 33.7 based on their maximum capacity. This is probably due in part to attractive sort of pricing for Chinese buyers of condensates, and the country seems to be kind of looking to increase its revenues and decrease the kind of floating storage it's got tied up at the moment using for condensates. Our view in terms of like production exports to Iran, based on our analysis of their current production figures, field characteristics and historical data is that Iranian production will reach somewhere around 3.38 million barrels per day in 2016, a 19% increase from the 2015 annual average, with around 500,000 barrels per day extra production likely to be made available for exports. So if we kind of move on to something else which I think is also quite interesting is looking at the average speed of VLCC carriers and how that relates to the freight market. This can be almost like a leading indicator sometime of demand going forward. So we're able to try and track the average speed of vessels by comparing their reported AIS positioning over time. And the data average for all the laden and unladen dirty VLCCs show the correlation between dirty freight rates on the route. We saw that there's been a spike in the kind of Ras Tanura Chiba route, which is typically used as a reference for crude flows between Middle East and Asia. So as the rate rose above $20 a metric ton, we saw an increase in the speed of unladen VLCCs as they effectively increased their speeds to kind of take to the loading points, take advantage of the demand and rates. I think we saw a sort of peak around 13.4 knots on average. So it appears the freight rates on the routes have eased somewhat, but remain higher than we saw in August, averaging around $15 a metric ton, with a similar fall in average speeds. It's worth perhaps mentioning that average freight rates for VLCCs this year have been the highest since 2008, at around $52,500 per day, according to tanker owners. I think this type of analysis can be useful for determining buying interest on routes and for other cargo types where freight rates can be sort of easily obtained. So just to kind of summarize in terms of our view on OPEC, I think that the cuts by Saudi Arabia to its November OSP really did have the desired effect at attracting more buying interest from Asia. And I think that obviously the Dubai pricing has helped that somewhat. But saying that, I think overall exports have remained lower than they were around Q2, Q3, particularly obviously with maintenance in Asia taking its sort of effect on overall demand. Falling kind of spot rates in places like Russia, North Sea, West Africa are also like to direct more kind of competing barrels towards the east, where margins are obviously stronger and product inventory and pressures are a little bit less than they are perhaps in the US and Europe. With Russian ESPO making kind of inroads into China, Saudi Arabia and others are like to kind of continue to look for opportunities in Europe for their kind of increased output. And this kind of brings me on quite nicely into the sort of second half of my presentation, which is looking at how kind of European flows have really been affected by the current low oil price environment. So if we kind of turn our attention to our kind of overall view, it's a bit similar to how we look at OPEC, as this is kind of looking at the largest seaborne crude exporters to Europe. So refiners have like continued to take advantage of relatively abundant cheap crude despite the slide in product margins that we sort of saw during the summer for gasoline in particular. And now we're seeing an impact on inventories of clean refined products in the ARA hub. And these are really kind of starting to feel the pressure in terms of ullage. Our flows tracking allows us to look at the largest exporters of crude into Europe, and this highlights that while North Sea and Russian grades remain largely favoured for baseload capacities, lighter West African and Middle Eastern grades were keenly consumed by refiners looking to produce more gasoline for export during the summer. They took advantage of higher production in the Middle East and Asia's shifting appetite to and from some West African grades. In the ARA in particular, we saw imports of Nigerian crude jump sharply in July, as did Norwegian sort of grades, with refiners switching away from heavier Russian grades like Urals, trying to look for kind of more lighter product yields. The trend appears to reverse somewhat in October, with Russian imports increasing as cheap spot rates and seasonal demand for diesel seems to have incentivized refiners to pick up cargoes for processing or for storage. Northwest Europe, unsurprisingly, still overwhelmingly favors North Sea and Russian crudes. As with the ARA, the country increased intakes of Nigerian grades during the summer, as well as some opportunistic buying of OPEC grades from Algeria, Venezuela and Saudi, as refiners look to adjust their crude slates to incorporate reduced spot cargoes. And lastly, the Mediterranean has also imported a steady amount of Russian crude via the Black Sea ports, with exports of distillate-rich Azeri and Iraqi grades also heavily favoured in place of North Sea grades typically used in ARA and Northwest Europe. Following a summer lull, preference for Iraqi grades has been steadily increasing as refiners have switched away from gasoline towards heavier barrels, which are producing better margins. So as a whole, Europe imported around about 30% of its crude from European locations during October, with 32% of that from Africa and 20% from Russia and FSU. If we kind of look at the Russian picture, I think it's quite interesting, with spot Urals prices falling to their lowest since June 2014 during October on fears of a longer November loading program, and more Middle Eastern barrels heading into Europe. It would appear that the majority of buyers look to increase their intake of Urals compared to September. We've seen an increasing amount moving into the Netherlands, most likely as traders look to store crudes on hope that demand picks up either within Europe or for export. One interesting exception is Poland, which saw a sharp fall in its imports of Urals as the country looks to diversify its buying to include Saudi Arabian grades, which caused some to speculate if the move by Saudi into Europe is a response to increased amounts of Russian ESPO flowing into Asia, which is threatening to upset its market share. If we look at kind of European imports by region, this kind of gives a good overview of the kind of trends. I mean, competition between crude supplies into Europe appears to have heated up despite the fall in the product margins, with overall imported volumes increasing sharply in October as the usual flows from Russia and North Sea are forced to compete with more barrels out of West Africa and the Middle East, which struggle to find a home in Asia. There is growing expectation there will be too much pressure on European refiners to absorb all the barrels heading into the region, which is already seeing product inventories rapidly fill, which could result in further slides in crude spot prices and increased North Sea and Russian exports heading towards China. The Middle East has seen the strongest growth in terms of overall volumes into Europe, with a 14% compound annual growth rate since April. Russian and West African imports have also seen double-digit growth as refiners look to take advantage of the supply glut. If we have a quick look at refinery runs and outages, we saw that refinery throughput in Northwest Europe and the Mediterranean has accelerated since 2014, with utilization rates as a function of available and total capacity rising to multi-year highs. Given lower feedstock prices and healthy margins, refiners have sought to maximize profitability by keeping plants online. Total planned outages for 2015 are considerably lower for both European hubs, and our expectations for 2016 are much lower still. So if we kind of look more in depth, which we can do with our kind of bottom-up flow tracking, we can see the types of grades in terms of the largest grades and their chemical makeup for certain regions. If we look at the sort of ARA hub, our tracking allows us to have a look at this kind of detailed breakdown of characteristics. The variable quantities of 5 largest crude grades imported into ARA region highlights its use as a storage hub for commercial storage, with traders picking up cargoes for blending and onward sale, as well as for refiners operating in the region. So with a sharp slide in spot differentials, Urals imports increased sharply during October as improved margins and low spot prices incentivized storage plays. If we look at the changing gravity of crudes imported to ARA, we can see a shift in proportions of crude types away from lighter grades towards more medium grades, as refiners look for more distillate yields, as gasoline cracks weaken and seasonal diesel and jet demand increases. Also, if we look at the kind of sweet and sour proportions, they haven't really moved significantly, although we see more medium sweet grades from the Middle East being imported into the region. There have been an associated slide in sulfur levels. Our tracking also allows us to monitor the types of vessels discharging crude. So October saw around 75 vessels discharging the ARA. Due to the size and depth of the kind of ARA burst, we saw a large proportion of these being VLCCs and Suezmaxes, as crude flow from North Sea and Middle East on larger sort of vessels. If we kind of turn our attention now to kind of Northwest Europe, we can see that the picture is a little bit different, with sort of less fluctuation of crude grades being imported, particularly as refiners bring in their equity grades into their system. So Russian Ural still remains the favoured grade in Northwest Europe, with North Sea grades such as Gulfax, Statfjord, Ekofisk also kind of used quite frequently by domestic refineries. So as a result of this steady baseload capacity, the gravity kind of remains relatively stable, although Northwest Europe reflects a general market shift towards more medium crudes as distillates and heavy production demand increases. So if we look at the sulfur content, the grades are generally more focused on the sweet grades. The systems are not necessarily geared towards high sulfur grades, which are imported and exported from ARA. Many Northwest European locations are also constrained in taking larger vessels compared to ARA, so we still see a lot more Aframaxes being brought in, with around 57% of the 122 discharges being attributed to this kind of cargo size. I mean, lastly, if we kind of look at the Mediterranean, we see a little bit of a different picture. We've seen a steady increase in crude imports across several grades as refiners took on a lighter maintenance schedules. And they've used their proximity to some major exporters to benefit from high production and lower spot prices. So distillate-rich Azeri, Urals and CPC grades have generally been favoured during October, with buyers also picking up more Iraqi and Saudi barrels as Asian maintenance pushed more barrels into the Mediterranean. Med refiners generally have less flexibility in their setups compared to those in the Northwest Europe, and this is evident by the relative stability in terms of the gravity and proportions of sweet sour, with refiners generally set up to accept a higher proportion of sour grades than other refiners in Europe. As with Northwest Europe, med importers are generally constrained in taking VLCC cargoes from the Middle East. So that typically results in higher spot prices on a barrel basis, as buyers have sort of less choice in terms of the kind of large cargoes that they can purchase. So we saw that Aframax is made up somewhere around 49% of the 269 vessels discharging in the Mediterranean. So if I just kind of summarize here on the European flows, I think we saw a lighter European seasonal maintenance as refiners took advantage of strong margins, but this has really kind of resulted in high product inventories. This is really kind of weakened the appetite for crude, and with longer loading programs of several Atlantic grades, there's been a push as well of Middle Eastern barrels into Europe. It kind of appears that refiners are still switching their slates to medium grades for seasonal distillate production, despite sort of record inventories and sort of falling margins. So November imports, from what we've seen so far, appear to have fallen relative to October, and we think this is kind of as a direct response to these kind of inventory pressures that are currently featuring in the market. And I think overall, kind of our view of Europe is likely to be reliant on export opportunities next year to ease the inventory pressures and lift margins. But we think it will be a sort of highly competitive market for these refiners going forward. So that's the end of my presentation. I'm just going to pass you over now to Brian.
Thank you, Alex. It's interesting to look at what's going on globally. Of course, what we're going to focus on and look at for the rest of this is really what's taking place in North America. You really can't separate the North American market from the global market. They are all so interconnected. In addition to high product inventories, we also think that we're seeing very high crude oil inventories. We believe we saw evidence that China's crude inventories are basically full, as we've seen cargoes remain offshore, waiting for an opportunity to discharge into some type of storage or refining capacity. It appears to us that the storage in South Africa is full, and some of the remaining storage that's out there actually is in North America. So let's kind of take a look at what's been going on. And if we take a look at Cushing, Cushing has been an important and very interesting story really over the last year. Of course, we saw storage build to record levels when we had the constraints and did not have the ability to move all of the production coming out of the Midwest. We saw the extremely deep contangos that we saw back in 2010, 11, 12, 13. And then we were able to drain Cushing down to almost all-time lows. We got down to almost 21 million barrels and set an all-time low utilization back in July of 2014 at about a little over 27% utilization. After that, we saw ourselves get into really easy cash and carry economics with a storage play working out over 12 months. And between November of last year and April, we saw significant builds of 2 and 2.5 million barrels a week to where we set all-time record highs in April with almost a little over 65 million barrels of storage in tank, which represented about a 77% utilization of the total capacity. Now, the all-time capacity utilization actually took place back in 2011 at 78.5%. But if you go back then, storage capacity was just a little over 50 million barrels. Since that time, we've added almost 35 million barrels of storage capacity to Cushing, and we're continuing to grow. So we saw Cushing start to drain a little bit during the summer. We saw it come down as refinery runs picked up a little bit. Stuff came out of turnaround. But we've seen our price curve move back into cash and carry economics out for about 6 months. And as that's happened, we've seen Cushing start to rebuild inventories again. We're currently only about 2.5 million barrels off of the all-time highs at Cushing. Part of what has facilitated that has been the construction of pipelines allowing for the flows both into and out of Cushing. One of the big stories, of course, was the ability to remove Cushing from the oil from Cushing in the Midwest and be able to get it to the refining centers in the U.S. Gulf Coast. And momentarily, we're going to look at exactly what facilitated that. But people weren't really paying quite as much attention that during that same time period, we were also building infrastructure to continue delivering even more crude into Cushing. Pony Express, of course, came online, enabling crude to come from the Rockies and from the Bakken by pipeline directly into Cushing. Much more efficient to the rail economics by doing that. Very quickly ramped up above its original nameplate capacity of 230,000 barrels a day. They're now running easily, can push 320,000 barrels a day. I think currently they're running probably around the 310, 315. The Mississippian line, the Glass Mountain, of course then the large line Flanagan South coming from Flanagan down into Cushing. All of that has allowed a lot more Cushing oil to be delivered in from Canada and the Midwest production that's been going on. Initially, after the big bill, we saw a lot of relief when Seaway got reversed. And then Seaway, of course, was expanded to bring a total capacity to almost 400,000 barrels a day. The Trans-Canada line came online, adding another 700,000 barrels of production to take it away from Cushing. And then, of course, we brought on the Seaway Twin, adding 450,000 barrels a day. Total all, we actually put about 4.5 million barrels of takeaway capacity into Cushing in about a 2.5-year period of time. If you put that together with what we saw in the delivery that's been added in the last year and a half, you'll see that, truthfully, we're back to about exactly the same place we were before we saw the southbound lines come in. We currently have excess takeaway capacity, excess delivery capacity into Cushing, Oklahoma of over 400,000 barrels a day of crude. It's interesting to notice that there is a general relationship between the builds at Cushing, the draw at Cushing, and the infrastructure that was built around that to support that. Now, at the same time, we've been building the transportation to come in and out of the center of the country. And Cushing is so important because it is tied to the NYMEX contract, and everybody watches that. That the development of additional storage around Cushing has just gone through the roof. Just in the time that Genscape has been monitoring storage at Cushing since 2009, we've seen it go from just a little above 50 million barrels of storage all the way up to currently the shell capacity is a little over 86 million barrels, and we believe that with the projects we currently see under construction, Cushing, Oklahoma is going to be able to handle over 90 million barrels of crude oil in storage by the middle of 2016. But Cushing is not the only story. You cannot look just at Cushing and what's going on with inventories there and really see what's going on. You also have to look at the Gulf Coast, which is almost an extension. Cushing has become so integral to supplying crude oil to the refining centers in the U.S. Gulf Coast. And, 6 years ago that was not true. The connection was going north. All of the crude moved from PADD 3 into PADD 2. Now with the directional flows going the opposite, you really need to look at what's going on in the U.S. Gulf Coast in conjunction with Cushing to understand what's driving really the pricing mechanisms within the U.S. So not only are we looking at high inventories in Cushing, but our overall inventories in North America are at all-time record highs year over year and substantially show. And if we look just in PADD 3, we're looking at someplace around 50 million barrels, more capacity, more storage than we have seen year over year ever. So part of that has been with the build out of storage capacity along the U.S. Gulf Coast as well. But just looking at the last 2 years, and even last year we were talking about really high inventories, yet we're over 50 million barrels higher than that right now. So even though the rest of the world is awash in crude oil and in refined products, so is North America. So it'll be interesting to see if overproduction continues like we've been seeing, and there is not a turnaround in some type of demand driver from the economic standpoint, whether that comes from China or a turnaround in the economic union, I'm not sure I see what's going to provide any change in the downward pricing pressure we've been seeing. We certainly got the news this week that OPEC's inaction to change anything. I think there was some hope out there in the marketplace that OPEC was about to give it up and provide some price concessions. I think there are members in OPEC who would like to do that. They came out of their meeting and there was no such relief in sight. The market has reacted to that, and it's really moved back to where the fundamentals have been, which is very much a bearish picture. So we look at PAD 3, it's high. If we look at exactly what we monitor in PAD 3, which is primarily along the Texas Gulf Coast, we can see the breakout. And even though there's been modest draws in Houston recently, the overall picture is a continued trend of building inventories along the U.S. Gulf Coast. Some of that in refinery operational inventory located at the plants. The majority of it is growth in the terminals area, though. So we just see inventory continuing to grow in crude. I'm not sure we see a lot of relief in that. We see production maybe starting to fall off a little bit, but it's certainly not falling off the cliff. So I'm not sure I see anything other than the expectation that some of these crude flows that we've been seeing may ultimately have to be forced into the U.S. Gulf Coast where there is storage capacity still left. So if you look at where we are in the U.S. Gulf Coast, not only are we sitting on about 140 million barrels of storage, but we know that there is 19 million barrels of current above-ground storage capacity under construction between Corpus Christi and Beaumont. There's some other construction going on in PAD 3. There's some small construction going on out in West Texas. But the majority of it is along the Texas coast. Some are new terminals, mostly located on water, providing export capabilities, whether that be export to other places within North America, or like recently we see a cargo of condensate that has been stabilized that's currently on its way over to the UK that came out of Houston. So more storage is being built in addition to the above ground storage. We're aware of a storage cavern being constructed that should start out being able to hold about 13 million barrels of crude oil. We initially, after summer, started seeing a real migration of that inventory from the Midwest and Canada coming down to the U.S. Gulf Coast. Most of that has, of course, come through the pipelines. We saw draws in Cushing. We saw draws in Canada. We saw build in the U.S. Gulf Coast. In the last couple of months, we've actually seen a little bit of a reversal in those pipeline flows. A lot of that, we believe, was related to the seaway system and some maintenance that was going on. We certainly saw the total crude flowing down the seaway system slow down for several months. You can see that in the graph on the orange. And at the same time, you're looking at exactly what the Gulf Coast storage did. Even though we saw a fall off in pipelines delivering into PAD 3, you really did not see a fall off in the inventory in PAD 3. We just continued to stay stable and build. So if we take a look at that whole thought process of the southbound migration, you can see where that kind of has broken. And not only have we seen the southbound migration of barrels stall, but we've seen a continual build in Cushing, in Canada, and in PAD 3, which just goes to supporting the overall view that there's still excess production coming into the market, and there's no real relief in sight to the excess crude oil that we have within the U.S. and as a global picture globally. A couple other just interesting things and observations I'll take outside of North America. most of them Alex covered very, very well and in a lot more detail. We have seen a fall off in exports going from the Middle East and West Africa to Asia, and we've seen a fall off in those also coming to the U.S. and West Africa, but we have seen an increase in that going to Europe. In particular, and Alex mentioned this, I was interested to see for the first time, we see Middle East crude actually going up into Poland and also have seen it run by green. Those are not traditional markets for Middle East barrels, and it goes to kind of highlight the whole market share war that's taking place between OPEC and Russia, which is absolutely going to put pressure on prices and should flow into North America as well. We've seen a steady trend of decreasing exports from West Africa and the Middle East to Asia. And we had been seeing a trend of an increase of Middle East barrels come into the U.S. Gulf Coast, but noted that in November we saw a reversal of that trend. And it'll be really interesting to see whether or not that reversal continues through the month of December. The other thing that's going to be really interesting to watch related to Cushing and Gulf Coast inventories has been the reversal of Line 9 and the systems that can now deliver crude from the Bakken field, Canada, and some other Midwest barrels up Line 9 into Montreal. We've been tracking many North American cargoes that have been going from the Eagle Ford or from Houston around up into Canada and delivering to the Montreal refinery as well as the refinery in St. John. With the reversal of Line 9, I think you're going to see a shifting of those North American crude flows. You're going to see the pipeline economics drive more Canadian and Bakken straight up Line 9. And it'll be interesting to see those barrels that have been coming out of the Eagle Ford or the Permian that have been going on vessel around the east and up into those markets. We expect to see those probably slow down, and they're going to have to find a new home someplace down on the East Coast. But overall, inventories are building. They're going to continue to build. Again, we set new 6-year lows in the overnight, trading all the way down to 36.68. And price pressures, there's absolutely nothing in the fundamentals that we're measuring that would make me believe that there is any relief to that price pressure in sight. So I will now turn the program back over to Amanda and be glad to take any questions.
Hi all, thank you for listening in. We'll start the Q&A session. Please be sure to type your questions in the box below. You can go to genscape.com/oilservicesreuters to request a free trial and see how Genscape data over Icon works. So the first question we have is for Alex. Regarding Iraqi exports via Ceyhan, does this crude first move by pipeline to Ceyhan? If so, to what extent can ISIS interrupt the pipeline flows?
So to answer the first part, yes. I mean, the crude does move via pipeline to Ceyhan, but I think for the most part, though, we haven't really seen much impact from IS activity on that particular pipeline. For the most part, any kind of disruptions have been things like theft, and other kind of technical issues which really have impacted kind of Kirkuk exports. The country is obviously now undertaking a lot of autonomous sales, which is quite interesting. But in terms of kind of the impact on kind of IS activity, and the same really for exports of Basra, it's been relatively minimal, with most of the kind of troubles sort of situated a little bit further away from the kind of main fields and infrastructure. So we haven't really seen any major impact from that at all.
Okay, another question for Alex. What impact could Saudi focus on Europe, and what could it have on Europe's refinery competitiveness versus U.S. refineries?
Yes, I mean, it's quite interesting when we sort of touched on it in this presentation. Obviously, the thing that really kind of limits maybe Saudi's kind of move into Europe is things like, obviously, the freight economics in particular. Obviously, if they're loading very large cargoes and sending them across to Europe, then the freight kind of differentials have to make sense. So the fact that they've kind of sent these all the way around to Poland and Sweden, etc., is certainly interesting, and I would imagine that they must have had either very good freight rates or very low prices to make those kind of make economic sense. So in terms of how they can kind of compete, I mean, obviously if they have favorable agreements and they can kind of undercut the competition, even with freight taken into account, then they really could pose a serious kind of challenge to, Russian or West African flows. But obviously they are constrained in terms of where they can take these larger cargoes into Europe. I mean, in terms of how that compares to the US, it's very difficult to kind of say, but I mean, obviously the US itself has, to a degree, far more complex refineries and has different kind of operating costs and things like that, which gives them a kind of a competitive edge. So I think for the most part, we're still generally going to see the US being a major product exporter into Europe. But, as we kind of see more Middle Eastern flows coming in, things like, I think, Iran moving into the Mediterranean, those kinds of things, we may sort of see a lot more competition in sort of the Atlantic basin as these kind of grades kind of compete with these Middle Eastern flows coming in.
Okay, and this one's for Brian. Based on incremental cost of production, how long can OPEC sustain these production levels?
Well, if you look at, because almost all of the OPEC countries are nationally owned oil companies. So much of this is tied to their national budget. And if you look at the budgets, the crude oil cost that's necessary for them to meet their budget expectations are significantly higher than where they are right now. Some of those countries actually were showing a need for $140 crude to be able to break even with their budget. I think the lowest number I saw was about $70. Right now, OPEC has basically made a decision that they are going to defend market share. The Saudis are certainly leading that charge. So if you look at the cost of production alone, most of those countries can sustain prices even lower than where we are. They have some of the cheapest production out there. Most of it's land-based. A lot of it is fairly old infrastructure. There's a lot of sunk cost in there. So I'm not sure that the pricing pressure or the pressure to increase prices within OPEC is really going to be driven as much by cost of production as it's going to be driven by pressures, budgetary pressures within their country. I'd be really interested to hear Alex's take on that as well.
Yeah, I mean, I think you're quite correct. I think the kind of OPEC picture is really a tricky one to kind of look at in terms of how much their production really is going to keep going. I think that we really kind of will see more and more kind of production coming out of the country as we kind of go forward, and it's definitely going to be one to kind of keep an eye on. I think definitely.
Okay, this next question is for Alex. When does China fill its SPR?
Yeah, I mean, that's a good question, but difficult to answer. I mean, Chinese sort of SPR construction seems to, almost seem to be just continuing. I think I mentioned in the presentation, I believe that estimates are around 60 to 90 million barrels being purchased next year for new SPR capacity that's being constructed. So it's an interesting thing to kind of look at, because obviously with China's economic slowdown, we haven't really kind of seen any major impact in their crude buying patterns, because they have this SPR demand and they're obviously taking advantage of these low prices. It really is kind of masking perhaps the true demand. So in answer to the question, in short, we don't really know, but I think that China's sort of activities next year are probably even going to be increased if we believe the kind of reports that are coming out of the country. I see them as being still a major participant in the market, and obviously a major buyer of crude, and therefore countries such as OPEC and other countries are going to be looking quite intensely at China and trying to kind of solicit these kind of term agreements particularly obviously with Iran coming back. I think everyone's going to be kind of fighting to get their interest going forward to fill these kind of SPRs.
Okay, this question's for Brian. What is operationally full for U.S. crude oil storage?
Well, it's an interesting question, and we can make some assumptions and some guesses at that. Part of that is historical, and I will start with Cushing. We've never seen Cushing go above 80% utilization. Now remember, when I say 80% utilization, I'm talking about the way we at Genscape measure it, which is 80% of shell capacity. We think that that's probably true for almost all of the terminals. But if you look at the capacity that's available at refining plants, then I doubt that they could ever see a 80% capacity. They need to be able to utilize their storage to blend appropriate slates. So they're taking crude from tank 1, 2, and 3, blending them to get the appropriate crude mix that they want to run to optimize the plants. So I would be really surprised if I ever see storage at the refining complexes in total probably surpass 60% of their utilization. So in the U.S. Gulf Coast, we've actually split out how we measure inventory or where we measure it at, so that within our U.S. Gulf Coast product, you can see the inventory both in regions of Corpus, Houston, and Beaumont, but we've also split it out by the storage that is at refining complexes versus those that are in terminals, because we believe those inventories behave very differently.
Okay, another question for Brian. How long until prices come down dramatically due to high storage if oversupply continues? How low does it go factoring in transport costs to Cushing or the coast?
I wish I actually knew the answer to that question. I've retired from Genscape, put on a trade, and retire. How low can it go? If you look at really net backs into the well, and the best estimates I've seen on cost of production, you have different answers for different production areas. I've seen, given the efficiencies that have gone into drilling and the ability to finish out wells at significantly less than even 2 and 3 years ago, the net back break even in the Bakken is probably someplace in the lower mid-40s. So new drilling in the Bakken right now I think would be under extreme pressure. The DJ Basin is a little cheaper than that. The Eagle Ford probably in the mid-30s, and probably the cheapest out there is in the Permian. Exactly what those prices are to provide the net backs, I don't exactly know. So much of that has to do with the efficiencies of how well the drillers are doing and the expected production out of those wells. But I would think that as we're seeing crude touch below $37, I think we could possibly see even the low of 2008, the 32.40 low could possibly be challenged. And a breakthrough below that, certainly that would be enough to cut production. The interesting thing, as far as new production goes, one of the things that has affected that, even when we saw the big drop like this last time, the contango was much steeper, and you had a forward curve going out still up into the $50. So you had companies that could go out and hedge production 12 months out at a price that still allowed them to break even on the crude. The important thing to look right now is not only are we seeing crude in the front month down in the $30 right now, but the contango is not nearly as steep as it was last time we were down here. So you're looking at 12 months out, crude still only being about $45, $46. At that rate, you're starting to put pressure on every single one of the North American fields.
Thank you, Brian. Another question for Alex. Is the main market share battle in the future going to be between Saudi Arabia and Russia? Who will blink first?
Yeah, I think that's a great question. I mean, there's been a lot of talk, obviously, with places like Iran coming back into the kind of picture, but I think that the kind of battle between Saudi Arabia and Russia really is one that's going to be the most prevalent perhaps next year. Russia has a strong advantage having a pipeline almost effectively into China, it's really kind of made a lot of efforts and inroads to really kind of solicit the Chinese kind of buying interest. And I think this really has raised the ire of Saudi Arabia, and they seem to really have been making a very strong push to kind of keep their market share in China, realizing that going forward, if they want their strategy of increased production to really kind of work effectively, they really need to kind of keep this kind of Chinese buying interest happy. And I think that they've perhaps been a little bit taken aback by Russia, who appear to have kind of increased their production, beyond Soviet levels at the moment. So I think they really have caused a lot of surprise. I mean, to be fair, Russian kind of supplies into Europe are pretty much as strong as ever, despite the kind of fairly frosty relationship with kind of Russia at the moment. So I think it really is one to kind of keep an eye on. I think that with the SPR buying in particular, there's going to be a lot of kind of conflict, perhaps as sort of tries to attract Chinese buying by either offering things like free freight rates or very low freight rates from the Saudis. Obviously, they have a lot of term deals, but if I was guessing, I would assume that the Chinese have, for the most part, kind of kept their term agreements to a degree in place, but have kept themselves a nice wide open optionality to kind of take more share from somewhere where they decide it's advantageous. And I think Russia's going to really kind of make sure that they're at the forefront of their mind when they're sort of looking for additional purchases. So it really will be, it could effectively be a race to the bottom, but it may not be. So we may kind of need to keep an eye on how that sort of plays out over the next year.
Okay, another question. This one's for Brian. How are you able to monitor above-ground storage build-out in Pad 3, and do you have estimates of how much storage is coming online?
We do have estimates of that. We monitor inventory. If you're not familiar with our process, we actually fly over all the storage areas on a weekly basis and measure the inventory in the tanks using the thermal technology and high-resolution photography that we use. And when we do that over those areas, then we're currently monitoring construction that's going on in existing terminals. We're also looking at new terminal construction that's going on in those areas. We also monitor any permitting activity that goes on. So every single tank that is built and every single terminal that goes under construction has to have permits, governmental permits done beforehand. So by monitoring the permit activity and looking at the area, we're able to know where construction is taking place or going to take place. What we're monitoring, that 19 million barrel number, that's where we are actually seeing either the ground prepared and pads prepared to put the tank on. The tank may be halfway built. The tank may be almost all the way built. They're in different stages. So we actually watch those as the construction goes on to completion, and then as soon as they come online and the hydro testing is done, and we actually will put out oftentimes information in intelligence reports that talks about new tanks have finished hydro testing and are coming online. And then we see them starting to fill with crude, and they get added into those tanks in which we monitor on a weekly basis. So we monitor the construction on a weekly basis just like we do inventory.
Okay, so it's just about 10 o'clock. I think we're out of time for today. We will send the recording and slides following the presentation. Thank you for joining.